Hello there, and welcome to our show. My name is Lewis Wieland, and for the last 30 years, I have published the official relocation guides on Atlanta that are distributed by the First Multiple Listing Service of Atlanta. The First Multiple Listing Service of Atlanta is the third largest multiple listing service in the United States. Over 60,000 agents use the website fmls.com every day for listings and buying and helping clients buy and sell residential and commercial real estate. And the First Multiple Listing Service serves realtors in not only Georgia but also Florida, Alabama, and Tennessee. And Community Profiles Magazine, it has a website called atlantacommunityprofiles.com. And on that site, you'll find the magazines and some of our podcasts that we do every week or so, whereby we interview community leaders, community and business leaders, community government and business leaders. I'm also a commercial realtor with KW Commercial. If I can help you with any of your real estate needs, buying, selling, leasing, or investing in commercial real estate, please let me know. And today we are very proud to introduce Mike Ryan, who is the Vice Chairman of CBRE, in charge of debt and structured finance for the Atlanta office. Welcome to the show, Mike.
Thanks for having me.
He worked for Cushman and Wakefield for 4 years in D.C. before he opened the firm's office here. And with Cushman, and he has facilitated the closing of over $16 billion, and that's with a B, in senior debt, equity, preferred equity, mezzanine, and construction financing, and has consistently ranked as one of the top 100 brokers in North Atlanta. So great to have you on the show. And he's also his other affiliations are Urban Land Institute member, National Multifamily Housing Council, and Mortgage Bankers Association. He graduated from the University of Wisconsin-Madison. So that being said, just a little background on the CBRE. It is named Fortune's most admired real estate company for 4 of the last 5 years. Fortune magazine's most admired real estate company. Named the world's most ethical company by Ethisphere for the 10th consecutive year. Named to Bloomberg's Gender Equality Index for 4 years in a row. The company has been ranked number 4 on Barron's Most Sustainable Company list, and on and on. The CBRE is one of the most admired companies in the world. They have over 500 employees in 100 countries. They have involved in almost all of the Fortune 500 companies, 95 plus. Again, 115,000 employees in over 100 companies. They're a global leader in commercial real estate services and investments. It's an amazing, amazing company, and we are greatly honored to have you on the show today, Mike. And Mike, what is going on with the interest rates, and how is it all of this affecting our lives today and going forward in terms of real estate and values, and the need to reset the mortgages? We have over $1 trillion in resets coming in the next couple of years, and where have we been on that, and where are we going here, and where we are now? And we have a lot of different property types to discuss. So
it's an interesting time in commercial real estate. Generally speaking, we've been in a decrease in interest rate environment for 30 years. There have obviously been blips where it increased, but with inflation, the Fed trying to get inflation under control coming out of the pandemic, the rates have never increased as fast in such a short period of time. That has led to stress in the banking system. Obviously, we had some large bank failures earlier this year. And as that's occurred, we've also seen credit spreads widen at the same time. And so we were we were closing on loans that had, 2.5% to 3% interest rates 2 years ago. Those same loans today are now 6 to 6.5%, give or take, or could even be wider depending on the asset class. And so with that large of a move in interest rates, the ability to finance assets for accretive leverage has become very challenging, which is now resulting in decrease or pressure on values. There's just a very limited amount of liquidity in the system right now. Generally speaking, domestic banks are reluctant to put out loans. Their balance sheets are under a lot of pressure with the rise in rates. And then life companies, they don't have an infinite source of capital, and they're able to hit their allocations while quoting very conservative leverage points. And then Fannie and Freddie for multifamily product remain, a very liquid staple. That's where most of the agents or most of the multi deals are getting done right now. But even so, that's at rates that are easily 2, if not 3% higher than they were 2 years ago. And so with the higher interest rates, lenders are not able to, they're sizing typically to a 125 coverage ratio on stabilized assets. And now with the high rise in rates, loan proceeds are decreasing, which is going to be a challenge for the loans that we have maturing over the next 3 years. In the intro, you said, the number I just read yesterday, it's $1.2 trillion of commercial mortgages will mature over the next 3 years. And most of those mortgages will require either fresh equity to pay down the loan, or the sponsor will be required to sell the asset, because with rates are where they're at right now, it's very challenging to get a cash neutral refinance done right now.
How will that affect prices when all that takes place, or during that process?
Yeah, if rates and credit spreads remain elevated, we're definitely seeing downward pressure on prices right now. It really varies by asset classes. With office is definitely taking the biggest impact, because the other asset classes right now, we're dealing with the capital markets dislocation, but the fundamentals remain strong. Industrial is incredibly low vacancy rates. Multifamily rents continue to grow, albeit at a slower pace. Retail is incredibly strong. If your retail center survived, quote unquote, the internet and COVID, it's usually a very healthy center. So fundamentals are strong in most asset classes. Office is unique in the fact that it has the capital markets dislocation. However, people are very concerned about the long-term fundamental demand of office space. With the hybrid or work from home, we are generally seeing there's not that many tenants that are expanding. Across our United States platform, I think 1/3 is new or growing leases. The balance of it being 2/3 of leases are either sublet or contracting space assignments. So generally speaking, we're seeing very soft demand from office tenants, and as a result, people are getting very conservative in their office underwriting, and that's had material downward pressure on office values.
I toured the Microsoft office downtown recently, and what a new concept in working at an office. What is the impact of this new stock on the demand for the old contemporary type offices where you don't have health clubs or swimming pools or saunas or jacuzzis or any of that?
And that's been the interesting piece. Where people remain relatively bullish is on best-in-class new office, and the premise there is employers are going to need to provide employees a different work experience, a different environment than your 3-story suburban office, parking lot situation. And so, we do continue to see good demand, decent demand for brand new trophy Class A assets. Jamestown just set a new record right by Pond City Market. The software companies going in there at $70 a foot. So we are seeing tenants willing to pay up because the cost of real estate for an office tenant is pretty low relative to their overall operations. And so if they're able to spend a little bit extra money on a better office environment for their employees, their goal is to get their employees back into the office. And so long-winded answer is, new trophy Class A office, people expect that to, outperform commodity or B assets for the foreseeable future.
How does the working in an office versus working at home benefit the culture of the corporation in your experience? And it's a new kind of...
It's very interesting, both personally and then studies we read. It's almost probably the opposite of what we probably expected when the pandemic started. What we're seeing is the younger junior folks want to be in the office. They want to be there to learn, to make friends, overhear conversations, the water cooler talk. You overhear and learn a lot just by being around people versus if you're sitting in your home office, you can be productive and you're getting your task done, but you're not getting that ancillary benefit of having friendships at the office or overhearing a conversation that allows you to just jump in, learn something. Those impromptu meetings that create culture, that creates new ideas, you lose that by working at home. But the interesting thing is what we've seen in most studies is the more senior you are, the more likely you want to work at home. One, you have a bigger house where you probably have an office. Put it in perspective, one of my analysts had to work on his bed because he was in the studio and his girlfriend was sitting at the kitchen table. So the physical needs for someone that's older, they usually have a home office and they've been at their career long enough that they don't necessarily need to bump into someone to have new ideas or learn. And so it's been a little bit of a surprise that generally speaking, the more senior you are in your career, the more likely you are to want to work from home. And so, within CBRE and most major corporations we talk to, people they're trying to get their employees back. But right now with the job market as tight as it is, the employee has the power. I think at some point, if we go into a recession, we'll see more return to office. But right now, it's really a balancing act of getting people back in to create that culture, to grow and nurture and mentor your younger staff, while also trying to maintain some work flexibility for the rest of the group.
Now, and looking into your crystal ball there for a minute, Mike, what's to become of the vacant office space anyway? The owners of this space are probably trying to figure out what to do with their space. What does it look like from your perch?
It's hard to generalize because each deal is right now, everything it's very hard to generalize. But if I had to try and do it, if you have we have a client that has 2 office buildings in suburban Atlanta. Both buildings are 50% occupied. What they're doing is they're moving tenants from one building to the other one. So that asset will be 100% occupied, more or less. And they're going to sell off the vacant office building to a multifamily developer who will scrape the building and build multifamily there. So I think you're going to see moves like that because at some point, the net effect of rents and demand, you're really starting to get down to the point where it could make more sense to sell it for land value than to try and operate it as an office. The conversion of office to multi is a very popular topic. Unfortunately, I think it's going to be way overblown, especially in the Southeast. And the reason being is, generally speaking, post-World War II, when office buildings had air conditioning, et cetera, the floor plates changed so that they're bigger, the windows don't open, and the floor plates are not set up for converting to multifamily. There's just not that much usable space. So in order to be able to convert an office building to multifamily, you almost have to buy the office building for dirt value or land value. In the Northeast, where you do have smaller footprints and older buildings or certain coastal cities, that the conversions will work, but generally speaking, in the Southeast and Atlanta, there's just not that many buildings that are physically configured to be a great multifamily conversion. So I think we'll see some conversions, but it's probably not to the scale people are hoping. And after that, it's going to be a wait and see approach. I think the Class A's and trophies will continue to do well, but the rest of it, it's I think I don't know if anyone has a full answer as to how this plays out yet. The only thing I will say is I think it will take a lot longer than everyone anticipates, because we have to remember that tenants have leases. There might be a 10-year lease in that building, and so the ability to demo these assets or convert them is subject to in-place leases, in-place financing, and price pressures. And so that doesn't happen overnight. So we do anticipate this is going to be a slow burn before we really get the office market normalized again.
Does it look like a lot of teardowns of those buildings, that it just cannot be financially viable to convert them to multifamily? The land, like you said, is
I think that will happen. The challenge there, or the issue which will take time, is in order for someone to sell an office building for teardown value, it usually means it's already been foreclosed by the lender, or the lender is doing a short sale, because very rarely are these owned by all cash by someone. And so, if you get that to the point where your office building is worth the land value or teardown value, you're typically having to work it out with the lender at that point as well.
You mentioned earlier about the fact that industrial is doing really well and retail, it looks really strong. Why is commercial doing so well relative to other property types?
When you say, you mean the industrial versus office, or?
Industrial, like, for example, how would you define industrial? I define it partially as warehouse space, that sort of kind of. What other description? How would you define commercial?
Yeah, you got warehouse space, distribution space, and that the industrial market has been on a tear for 6 or 7 years now. It was hot before COVID, with supply chain disruption. Tenants were actually looking for additional space to have backup capacity as the supply chains got reworked. But overall, there's been continued growth with the internet that also got fueled by COVID. That seems to have normalized a little bit. But generally speaking, I think just structurally within the U.S. system and distribution channels getting reworked, that's created a lot more demand. We all think of Amazon as the 800-pound gorilla, but there are plenty of groups out there that are trying to do direct to consumers as well. And then within the warehouse space, not necessarily distribution, the overall U.S. economy continues to grow very well. And so your mom and pops that might need a 50,000 square foot space for your plumber, that market continues to do great. And the infill stuff, for example, like a Kennesaw, the cost to rebuild that is, you can't build it today for what it's renting for. So there's really been no additional supply for infill product, and that's what led to strong rent growth.
What about the technology and changes in the commercial space and for the industrial space? I mean, in terms of changes in technology, it looks like a lot of it is robotics involved. The most phenomenal technology changes that seem to be in that property type. Have you noticed that, and how's that affecting growth?
That definitely is a growing influence. It really is tenant specific in terms of that technology. Like an Amazon distribution facility is incredible. Other groups are using their warehouses more for whether it's light manufacturing, et cetera. Technology it depends on the use of the tenant. It allows them to utilize their space more efficiently with less people in the buildings. Payroll for an industrial user is typically, I'm going to get my numbers wrong, but I want to say, it's less than, the cost of the real estate is less than 10% of the overall operations. And so the technology and infrastructure that these tenants are putting into their spaces allows them to operate more efficiently, but it also makes them a much stickier tenant. If I invest, $10 million into my warehouse, the chances that I'm going to vacate it at the lease expiration is probably pretty small. So we're also seeing with the limited vacancy in the market that tenants really oftentimes don't have another option to move unless they're trying to do a build-to-suit or find find a building that's under construction, and lease that prior to it delivering.
And moving to, let me ask you this question first before we move to retail, and that is, are there different interest rates for different property types based on their potential for growth and improved prices?
Not necessarily growth per se, but there's definitely different rates for perceived risk. So, for example, office right now is perceived as the riskiest asset class out there. That might price at 350 basis points over, say, the 10-year T-bill, which today would be upper sevens, pushing 8%. Meanwhile, multifamily with Fannie and Freddie providing loans in that space, that's in the mid to low sixes or even tighter depending on that. So the perception that multifamily is a safer asset class leads to much tighter credit spreads. So you'll definitely see a variance in interest rates with industrial and multi having the tightest interest rates, and then retail's in the middle with office being the widest, just given the perceived risk of office right now.
What is the average value of a deal that you have been doing for the last, say, 12 months? I mean, you are the largest and probably the most prestigious commercial firm in the United States or in the world. So, what is the average kind of deal that I know we spoke on the phone? It's pretty massive.
Yeah. So historically, we average about $100 million per deal. Right now, big is bad. Investors and lenders are not willing to make large bets. So we probably have gone from an average deal size of $100 million to probably down to $40 million over the last year or so. But that does run to a wide spectrum. We'll do a $5 million multifamily deal, and then simultaneously I could close a $500 million office deal. So it's a pretty wide range of what we focus on.
So that's interesting. How's the massive deals that you do every day impact, people in my line of work, which is in the smaller commercial world, like under 10 million for sure. How does what you do affect what I do and people at KW Commercial and people in these smaller firms?
Yeah, I think what I've enjoyed is, when you're looking at, say, for example, Midtown Atlanta, we financed the Google headquarters, the development of that. I believe you had Chris Aaronkeel on previously with Sea Lake Development. And being part of that capital raise and hearing about Google coming to Atlanta, ultimately Google is probably going to relocate upwards of 3,000 employees to Atlanta. If you work at Google, you can choose where you want to work anywhere in the United States. Atlanta has been their number one move to market, and it's also their number one return to work market. So it's a good vote for the economy of Atlanta and the overall economy here that, more Google employees want to move here than anywhere else in the entire system. They could live in San Francisco, Dallas, Austin, you name it. Atlanta wants to be, that's the number one return to or move to location for them. And so the deals that we work on when we're part of that understanding, like, all right, here's what Microsoft is doing over in Atlantic Station or Anthem and Coda, really seeing what are some of the large job generators where, being part of a transaction that we're aware that there's going to be 3,000 new employees coming to Atlanta. That's very exciting, and that has a huge ripple effect. And we financed Coda at Tech Square, and that really is what kicked off a chain of events that probably led to 15 different large software companies relocating or opening in Southeast headquarters. Anthem had built 2 office buildings for their IT group. BlackRock moved their artificial intelligence division to Atlanta. Then you have more household names like a Google, Microsoft, Salesforce. That was all based upon them learning about Coda and what Atlanta is. And so being able to be part of large transactions like that are really driving the city in a new direction and becoming more of a tech-oriented city it's very enjoyable and fulfilling to work on those transactions.
Now, we're getting to retail, but I just wanted to understand, CBRE, do you actually do listings and you do represent buyers? You're not just finance. Tell us a little bit about your company in that respect.
Sure. So we all specialize within our group. So as a finance person, we work in all the asset classes to raise money. However, we do have, a separate office sales team, separate retail sales team. And so the sales team specialize by asset class, whereas a finance person, we're a generalist because if I need to get a loan from a life company, it doesn't matter what the asset class is. I'm still calling the same lender because the lenders are generalists as well. So yes, that's a long-winded answer. We do list properties for sale. We also are leasing agents. We have appraisals. We basically, we probably have upwards of 25 different lines of business across both users of real estate and owners of real estate.
You are, like I said earlier, named Fortune's most admired real estate company in the world. I guess, or in the North America, or for the last 4 out of the last 5 years. Why is that? How come? What do you attribute such acclaim?
We have got great leadership here that is trying to continue to push CB in new directions, whether that's diversity, DEI initiatives, diversity and inclusion initiatives. And then conversely, it's a very employee-focused company, whether it's great benefits, whether it is making sure we have good corporate culture. The number of things that a management does to keep everyone together in the office, working and rowing in the same direction is great. I was at Cushman & Wakefield for 18 years, really respected management there. And CB, same thing. I mean, but there are a lot of good firms in the commercial real estate, but CB, in terms of size, is definitely the largest company in the world. I believe CBRE's market capitalization is larger than the next 3 firms combined. So I think that scale and breadth gives us some definite competitive advantages, as well as a different corporate culture that, if our clients need help anywhere in the world, they're one phone call away from getting connected to someone that can help them on their real estate needs.
I noticed on your website that you are dedicated to core values that are very admirable: honesty, integrity, character, morals, and values. And I think that's something that people pay a lot of attention to these days. And I admire your company very much and your success as the most admired. I worked for Dow Jones myself for 22 years and was a Southeast manager for the Wall Street Journal for 10 of those 22 years. And we did have the similar cultural values and corporate culture as you do. And we were the largest in print publishing, and still are, by the way. But anyway, going to retail, what the future of retail has been debated because of online sales, et cetera, and malls versus strip malls. But lately I've been hearing a lot about the success of strip malls and the demand for strip malls by investors, and versus malls while they're tearing down malls and converting them. Give us your kind of macro perspective on the retail.
Yeah, retail is an interesting asset class because it's always evolving, whether it is Best Buy going from a 35,000 or 40,000 square foot floor plate down to 15,000. So retailers have adapted to the internet. That's changed their space needs. There's been a couple of, retail, it's hard to paint with a big brush, and I think you hit the nail on the head. We're sitting there trying to tear down malls. Meanwhile, we're trying to build more grocery anchored deals than we have in a long time. And so certain aspects of retail have done very well. And necessity need or experience-based needs, that continues to be a strong spot in the market. And, by that, I mean, yes, you can order your groceries online, but, in general, people still are going to the grocery store. Yes, you can order food to go, but people still want to go out to a restaurant and sit down. So those are things that, or to get your nails done or get your dry cleaning done, those are things you have to go out and visit the retail center for. That necessity-based retail, I think people have realized, you can't throw the baby out the bathwater, and that will always be there. Meanwhile, conversely, certain groups that are exposed to the internet, whether that's the way that where bookstores went or electronics went, CDs, there's not too many music stores left anymore. So I think it's a little bit of the retail mix and those tenants as to where that investor demand comes from. And generally speaking, one of the strongest we've seen is, like I said, anything that is necessity or experience based that you really can't just, with a click of a mouse, get that same experience or that same need.
But the shopping mall concept is here to stay. Would you agree? And even though it may be structured a little differently?
Yeah, if we're talking about the enclosed malls, ultimately we over-malled the U.S., for lack of a better term. If you looked at the number of malls per person or per square foot in the United States, it was 2-3x most other countries. You could take a small town in Middle America and they had 2 or 3 malls. It just made no sense. They need 1 mall. They don't need 3 malls. So in some regards, those fortress malls or barrier malls, those will be there. They're going to continue to do well. But ultimately, in some regards, it's not too dissimilar to where I think the office world is going to go through, where I don't need 15 million square feet of Class B suburban office. Maybe I need 10 million square feet of it. And so ultimately, we will continue to demolish some retail that is no longer, functionally obsolete. But meanwhile, there's going to be continued development and growth in the retail for different types of tenants or different types of retail needs. So the retail is definitely the most nuanced asset class out there.
So shifting to multifamily, we have discussed it briefly, but in wrapping up, what big thing in multifamily is cap rates but that's not the bottom line in terms of evaluation. What are some of the criteria you use in evaluating the value of multifamily and besides cap rates?
Yeah, people talking cap rates, the per door metric is definitely coming back as the market's changed and values are getting impacted. What we are seeing is new built assets that are selling. They are selling today for below replacement cost today. That doesn't mean the developer's not making money. What it means is when they broke ground 3 years ago, their cost basis is, make my numbers up, was $200,000 a unit. Today, that same asset is $275,000 per door to build. So per door and cost basis has definitely come back in to play. The other thing is, depending on it, if it's older vintage product, mark to market, how can I go in and renovate units? Is there a way to push rents? And so on the deals where there's a clear value add strategy, the cap rates are lower because people are willing to pay more. Buy that up 4.5 cap, and then you'll grow it to a 6.5 cap. So it depends on kind of the vintage in play, and then more often than not, where you have large rent growth opportunities, you'll see a tighter cap rate. The more stabilized the asset is, the cap rates are a little bit wider. Generally speaking, we're seeing investors are willing to underwrite to 1 to even maybe 2 years of negative leverage. So where interest rates are, that's definitely factoring into how people are underwriting their assets. So it's a combination of ability to grow the rents plus what the financing looks like today.
With good credit and without personal guarantee or even with a personal guarantee, for multifamily under $5 million, what is an average cap rate anyway for buying it, and what kind of interest rates would they expect?
I'm going to have to take the fifth on that one. Once it gets under $5 million, I know Fannie and Freddie's pricing gaps out, but I'm not sure how much. And so in all candor, I'm probably not the right person to answer that one. I've got some colleagues that can answer that. That we've got a group that specializes in transactions under 10 million. And I'm happy to follow up with you on that.
Yeah, that'd be a good follow-up conversation or interview. But so any parting remarks about the future of interest rates and the interest rate changes of impact on the economy, which is definitely affected greatly by that?
Yeah, right now I'd say, the expectation is the Fed raises rates maybe one more time this year. They have been very vocal that the rates will be higher for longer. And so I think the people are starting to actually believe them, that it's no longer a bluff. And so you're seeing that impact the stock market. But generally speaking, we're expecting that the SOFR rates will probably plateau around 5.5%. And then gradually decrease over the next 2 or 3 years, hopefully, achieving a soft landing. The T-bills, that's kind of confused me. I don't have a good crystal ball on that one. But generally speaking, we're definitely near the end of the Fed hiking rates. If you look at most of the major metrics that they follow for inflation and projections, they're all trending very well in the correct direction. And so, I think a lot of people are cautiously optimistic that they can engineer a soft landing by getting inflation under control and then gradually lowering rates to kind of a more normalized neutral rate environment. Because right now we're definitely in a restrictive territory as they're trying to cool off the economy.
Thank you, Mike. Mike Ryan, who is Vice Chairman of CBRE, in charge of debt and structured finance in Atlanta, for CBRE, the world's largest and arguably the most prestigious and admired real estate company in the world. Well, thank you so much for taking time from your busy schedule to come on and talk with us for a few minutes. Appreciate it very much.
Absolutely. Thank you. I enjoyed it.
Thank you. Have a nice day, sir. Appreciate it.
You do.
Thank you for watching and have a nice day.